Assalamu alaikum friends, welcome to lecture 30 of SBL, Cost and Management Accounting. So it's going to be a bit of calculation and bit of, the theories. And this is one of the very important lecture because most of the time in SBL, one particular question, a small part of it will be from this part. So in this, we are going to go through the role of cost and management accounting. Okay, you must have done this in your previous paper, management accounting and accounting in business and all those things. So this is just basically the revision of it. There is nothing new, but it's just from there we have taken it, maybe in more advanced level. Then budgeting, variance analysis, and other quantitative analysis techniques. Okay, so starting with the role of cost and management accounting. These are the four roles of cost and management accounting, okay, that you use. In your SBL exam, they will never ask you, okay, list what are the roles of cost and management accounting. They never do that. But in the case study given to you, you should know. If you are given a question indirectly, okay, for example, how cost accounting might help in this company, cost and management accounting, you should be able to give these points that time. You should know these roles. Okay, so first is inventory valuation. We need to know the cost to value our inventory, right? Second, record cost. If you don't know about the cost, how can you record cost in your statement of profit and loss? Third, to price the product, we need cost and management accounting. If you know the price, you add a margin and then you make a profit. Let's say your cost is 0.3. The price you decided is 0.5. Obviously, it will be above the cost and your profit is 0.2. Fourth is for helping to make decision. Helping to make you decision. In what quantity to make, what item to sell, what item to disclose, discontinue, right? Based on the cost. Without this, you will not be able to do it. So these are the four places where cost and management accounting plays a big role. Okay. Now, there are problems with standard costing. It is known as standard costing. Why? Because it does not change. But in the modern environment, it's a problem. Why? Number one, products are often non-standard. Do you see similar products now? Earlier in the manufacturing department, yes, it was. Same product. One pen was made in the assembly line. It was the same blue color pen. For example, you want to make a blue color pen in batches, 10 pages, 20 pages. It is a standard product. So you can use a standard costing also for that, one cost. But now products are non-standard. They're not unique. Sorry, they are unique. They are different from each other. They're not same. They're not common. So you cannot use standard costing for those. Number two, standards can become quickly outdated. Your price might change. Quantity might change. Right? Production is highly automated. Because now it is highly automated, you don't know in the machine how much they are exactly producing, how much they are saving, what quantity are they. You cannot. If it was man-made, yes, you can say for the labor, this is the cost you are charging for the labor. Fourth, ideal standard is used. Often an ideal standard is used. There is nothing called ideal standard, that this is the best standard or the no. Modern environments are more concerned with continuous improvement. You continuously improve. This we do in variance analysis. Remember, variance analysis means difference between your budget and your actual. So you try to improve always in the modern environment. You do not remain the same forever. So the costing also cannot remain same forever. That's why when you do budgeting with the standard costing, it becomes very difficult. Modern managers need more detailed information. Okay. And real-time performance measures are needed. So in this condition, you cannot use standard costing. Using standard costing will give you a problem. Okay. For example, in your SBL exam, you have to see for the nature of the product, how it is. If it is highly automated, if it is non-standard, if it requires information in real time, then you have to give your conclusion that you cannot use standard costing. If the company has used standard costing there, you have to list these problems down there. Now we are moving to the types of budget. Okay. First of all, what is budgeting? I didn't include all the definition and all those things, blah blah blah, because it's not needed for your SBL exam. Okay, we all know budgeting is for planning. Okay, how much you're going to spend, mostly how much you're going to spend. Okay, it's just a rough idea, but you have to do your budget based on your cash inflows and outflows. But there are various types of doing it, the budgeting. Number one, periodic budget. We are going to go in detail in each of this. Rolling budget, incremental budget, zero based budget, activity based budget, flex budget. Okay, so these are the 6 type of budgets. Now let's start with periodic budget. As the word says, periodic, that means it is for 1 year. It's for one period of time, usually 1 year, 12 months you can say, giving you all the cost and the revenue. Okay, that means every 12 months it is updated. But this is a little bit outdated now, it has an issue. So that's why we came to rolling budget, or you can say another word is continuous budget. What is it? How this is different from periodic budget? This is different because they add another accounting period with the previous. They can add a month or a quarter. Quarter means adding 3 months with the accounting period. If the earliest accounting period has expired, they add another one. So they do not have to wait exactly 12 months to update. No. So when there are large amount of uncertainty, okay, that time you can prepare this rolling budget. At regular intervals, you decide what interval you want to prepare. For example, okay, if you're not understanding, let me give an example. When you are doing this forecast rate of cost, okay, or price inflation, anything, inflation might be high, right? Or your exchange rates. That time you can do this rolling budget. When it's very unpredictable, what will be the price inflation, what would be the forecast rate of exchange, because the business will be affected by this exchange rate. You cannot wait 12 months to update your exchange rate. You cannot wait 12 months to update your prices because of the price inflation. You have to do a rolling budget for the next month or for the next quarter that you are adding. Incremental budget. Incremental budget, what does it do? It takes the previous year's budget and just add a percentage or deduct a percentage. How much the cost increased or decreased. That's it. Exactly the previous budget only. Let's say sale is in the previous year it was 800. This year also they start from 800. They add or deduct based on the cost increase or decrease, just a percentage. So that's why it is known as incremental, just the changes. That's it. This approach is very popular because it is very simple, right? You exactly know from the previous year. But remember, it is not very useful in the environment which quickly changes and very unpredictable. Because we are assuming it will follow the previous year's trend with little changes. But if it's very unpredictable, changes very quickly, you cannot use previous year's budget and add percentage. Zero-based budgeting. What is it? This is a total change from incremental budgeting. It brings everything to zero. All the activities and the cost that are budgeted, you are creating from a scratch. Everything is zero. For every activity, what do the manager do? They try to look at the cost and they try to find alternative ways of doing it. So any items or any activity which are not so important are first identified and you eliminate them. So in the next year's budget, when you're preparing, what do? You identify those costs this year, remove it. But remember, it's not easy to just remove a task like that, saying it's non-essential. It's very complex, it's very time consuming, and it is a very expensive task to do it. Activity-based budgeting. This is based on budgets prepared by responsibility center managers. Okay, zero-based budgeting is prepared by responsibility center managers. But activity-based budgeting is prepared based on activities. In simplest form, okay, ABB is what? You are just using the cost that is determined by the activity-based cost. Okay. This is very significant when overheads are significant. But remember, this relies on the use of ABC, activity-based costing. Now, flex budget will be explained under variance. Okay, because after this, the next topic is variance. Now, how do you make a budgeting control effective? This you should know. From the exams point of view, this most of the time this comes. How can you make it effective? How can I have a good budgeting? Number one, serious attitude has to be taken. Number two, there should be a clear line of responsibilities, how responsible the managers are for budgeting. Third, it should be challenging. Remember, when you're setting a budget target, it should not be something which is very easily achieved, nor something which is very difficult to achieve, impossible to achieve. Because both the ways it will demoralize the employees. So you have to have a challenge, have to have some target which is challenging but yet achievable. That's how you keep them motivated. You have to establish data, you have to do analysis, and reporting techniques has to be there. Because without data you cannot create budget, and you have to analyze that budget, and then you have to report also. A report aimed at individual managers. Okay. Fairly short reporting periods. When you're budgeting, keep short reporting periods so that budgeting is very effective rather than keeping for long periods. Timely variance report. Give the variance report timely so that budgeting actually helps. Then actions being taken to get operation back under control if they are shown to be out of control. That's what budgeting does. And effective budgeting will do that. If you're out of the control, through budgeting, it will bring the operation back to under control. Okay. Now we'll be going to variance analysis. And first budget is flex budget. When you have to do variance analysis, you have to flex your budget. What is the meaning of it? We'll explain you through a question. So let's do that. So this is an example of a flex budget. Okay. Company has a standard cost of 8 per unit. Expect to produce and sell 20,000 units. Okay. Ignore any changes to material stock. It says it sets a material budget for the purchasing department of 160,000 in total. Okay. During the year, because of the celebrity endorsement, the product became very popular and actual sales was 30,000 unit. That means 10,000 more than the budget, right? Which was 50% above. Purchasing department has spent 220 on materials. But the budget was what? 160. They have spent more. So it makes sense that the material budget for the purchasing department should not be limited to the original this one, as now it has to adjust with a lot of extra material. So instead, the original budget is adjusted, or you can say flexed. That is the meaning of flexed. You adjust the original budget. Why? To show the increase in actual level of activity. This is how you do, and you have to do it, because without this you cannot calculate variance. Okay, for the other types of budget, calculations are not required. They will not ask you calculations, but for flex budget, yes. So first, write what are the original production units 20,000, material budget 160 because 20 into 8, right? Flex budget was 30 and 240. They have given you. So what is the actual? This is original. This is flex budget actual. Production unit. Okay. This is 30. This is 20. Actual they have given you. Here when they have flexed, they have changed. This remains 30,000. Okay. 240,000. How did they get 240,000? This 30,000 into 8, because they have given you the cost 8 per unit. They have used standard costing, and units is 30. So 30,000 into 8. So when you're doing a flex budget, it is 240. So when you're comparing actual, you're comparing it with the flex budget, not with the original. Understood? This is why you have to flex the budget. That's how you calculate variance. Flex budget minus actual. So here if you see, flex budget is 30, actual is 30,000. Why flex budget is 30? Because now you are bringing it to the activity of 30,000 units. With this you are comparing. You only have changed the material budget. You have just multiplied 30,000 by 8 this time. And this they have already given the cost. Actual cost. Okay. So that's why here you will not get any variance. But for the next one, 240 minus 220, 20,000 favorable. You see, because in the flex budget, it was 240. But actually you have spent 220,000. So 20,000 you have saved. That's why it is 20,000 favorable. Whenever you're calculating variance, that means the difference between budget and actual, you have to write whether it is favorable or adverse. Favorable means it's good for you, positive. Cost is less than the budget. Adverse means the opposite. Okay. So now we are going to go through examples of independent variances. Now we are going through examples of independent variances. For example, labor and overhead efficiency. Okay. If you are using cheaper materials, what type of variance are you going to get? You are going to have a favorable material price variance. Cheaper material means price will be less. Actual price is less than the budget. So you are going to have a favorable material price variance. But say interdependent. Remember, one variance will affect the other variance. You have to understand this relationship very carefully in the exam. So if you're having even though you're having a favorable material price variance, it will have a negative impact somewhere. So it's always positive impact in one place, negative impact on another variance. That's how it works. Even if you're saving on the price, but you're using cheaper material, that means quality will suffer. So you are going to increase your wastage rate. That means adverse material usage. That means it will call a fall in labor productivity. Hence, adverse labor and variable overhead efficiency. Second, if you use more experienced labor to do the work, what happens? Even though compared to rate, you have to pay them higher rate, adverse labor rate. But productivity will improve. Because of that, you are going to have a favorable labor overhead efficiency. Understanding? So one positive, one negative impact. Next example is, if you are changing the composition of a team, what happens? By using a cheap, that will result in a cheaper labor mix. That means favorable mix variance, but lower productivity if you are using cheap labor. Hence, adverse yield variance. Workers trying to improve productivity will improve your efficiency variance. But they are trying to improve productivity. Why? So that they can get a bonus. That means it will be they'll be paid high. So it's an adverse rate variance. And they might even use material wastefully also in order to save time, because they want to increase productivity, no, to get a bonus. They just want to do the task quickly. So because of that, they're going to waste a lot of material. Hence, adverse material usage. Then cutting sale price. Remember, if you're cutting sale price, it will give you an adverse sale price variance. Who wants to cut their sale price? But it will result in higher demand. Hence, sales volume variance, favorable sales volume variance. Now, what are the strategic role of budgeting, standard costing, and variance? All these three things are linked. Their only role is they are used as a control mechanism. Whether you do budgeting, whether you do standard costing, whether you do variance, you only want to control. That means they set some target. This is how they work. All three set some target. They measure the performance, highlight any error, and then determine responsibility and take corrective action. However, they all can have a forward-looking and a strategic role in forming an important part of the strategic decision. How? Doing all these three will tell you which activity you need to outsource, which activity you need to remove, which products can give you a new competitive position in the market, whether an accusation makes sense or not. Doing this three will help you knowing that. So it's a forward looking decision. Okay, now we are moving on to other quantitative analysis technique. the last part of this lecture. There are three analyses that you need to come across and you need to know about. One is known as correlation, the other one is known as linear regression, the other one is known as time series analysis. The word itself tells you. Correlation means it's like a relationship between two variables. Linear regression shows this relationship on a straight line in a graph. How one independent variable can have an impact on the dependent variable. We are going to do an example. We are going to do questions on this. Don't worry. Time series analysis. You analyze the set of data based on the time. Okay. Remember, in the exam, you must be able to explain and apply these techniques. Not all the techniques, maybe one or two. Then you have to explain, discuss whether they are suitable or not. You have to know the limitations of all the three techniques. Now we are going to do a question on linear regression. But before that, you need to know linear. Linear means what? Line. So any relationship can be shown in a straight line. That's what linear regression assumes. Okay. Linear regression is a statistical tool. You don't have to go in so much detail and actually do a linear regression. That's not what SBL is asking for you to do. But if a linear regression is given to you, the equation or the diagram or something has been mentioned, you should be able to analyze. At SBL level, at least that you should be able to do it. You're not going to be asked, some data will be given, x-axis, y-axis and told draw a diagram. No, that is in F level. This is P level. Things will be given to you. You have to analyze. You have to explain what it means. The meaning you have to identify. Okay. So basically, it's a model that shows how one variable is dependent on another. For example, cost. Cost, okay, is dependent on many variables, whether your cost will be high or low. One is volume. If your volume is high, cost will be high. Volume is less, cost will be low. Like that, right? So this relationship, cost and volume, for example, can be stated as an equation. This is the equation of a straight line. Y is equals to a plus bx, where y is the dependent variable. That's what we are finding out. That means what will be the cost. A will be given to you. B is the gradient. A is the intercept. You must have known this in maths, right? I'm not teaching mathematics here, but you can understand now how mathematics is useful, especially in statistics. Linear regression and all, mathematics is hugely used. But you don't have to know in detail, don't worry. At least know straight lines equation is y is equals to a plus bx. A will be given to you, b will be given to you, x will be given to you. You have to find the y. Okay, x is the volume. So linear regression can be used to forecast. Why do we do that? Through this we forecast. We need historical data for it. Through this we focus what in the future will be the relationship, what would be the, how much would be the cost if this volume is this much, if the volume increases in the future, what will be the cost. So through linear regression we are able to predict. It's like a predicting tool. Even though there is no 100% guarantee, no 100% accuracy, but somewhat we can use it as a focus tool, based assuming that relationship is straight, but there are limitations for that also. But before that, let us do a small question on linear regression before we move on to the limitations of simple linear regression. So here, X company is forecasting sales for the 4 quarters. Okay, linear regression has been done. A is 20, B is 0.7 and equation is this one. X is the number of quarter and Y is the sales value. Okay, calculate the sales for each quarter. Even though in SBL this type of questions will not be asked, okay, but you should know how to perform a linear regression. So this is how you're going to do it. Y equals to, for quarter 1, quarter 2, quarter 3, quarter 4. Okay, y 20. Okay, so you start with 20, 20, 20, 20 plus 0.7 is also given. You multiply 0.7 by the number of the quarter. They already told you X is the number of quarter. So this is quarter 1, this is quarter 2, this is quarter 3, this is quarter 4. And you get the answer. That is your Y. That is your sales. Here 20,700. This is 0.7 means it is, or you can just get as you'll be getting like this 20.7. But actually it is 20,700 because they told in thousands. 21.4, 22.1 and 22.8. You see? You don't have to draw the diagram and all. This is what you have to know. This is how you calculate. Now let us go to the limitations of this model. Limitations of linear regression. Number 1. It assumes a linear relationship between two variables. That means the X and the Y. Second, it only measures relationship between two variables. Have you seen it? Just now we saw a question, right? Sales and this one. But in reality, there are more than one variable that can affect, right? Third, interpolated focus tends to be reliable and extrapolation should not be used. What do you mean by extrapolation and interpolation? See, interpolation means something which is in that range. Okay, extrapolation means something it is outside that range. It's very far. You understand it? So for extrapolation and all, the equation should not be used. It's not useful. Interpolated focus, something which could be in that range, it's okay, it's reliable. Fourth, it assumes that they are following the past pattern, historical behavior of data. That means data you have collected and they are performing in a similar manner to the past. That's what regression assumes. But in reality, there are so many other things that you need. There are still roles that managers need to play. For example, it might be based on the experience, their intuition, their judgment they have to make for the forecast. Okay, not just by a statistical analysis. Because if there are sudden changes in the market, sometimes you assume that there will be sudden changes in the market and you start forecasting. Not just because based on statistical analysis, if you do, that means regression, they will not be able to get that sudden changes in the market that they cannot predict. That is something that you have to use your own experience, maybe you have in that market, or your intuition will help you. Okay. Now, there are further limitations. Number 5. Again, interpolated predictions are reliable if there are significant correlation. Even if you are using interpolated within the range, it has to be significant correlation has to be there. That means a relationship has to be there with that data. Sixth, accuracy of the forecasting is affected by the need to adjust historical data. You just cannot exactly use the historical data. You have to do some adjustments now. So your accuracy of forecasting is based on that adjustment. For example, if there is any inflation now, price or cost inflation, you're adjusting it. Now we are moving on to the second technique, that is correlation. What is correlation? Correlation means it attempts to find a relationship between variables and how strong that relationship is between the two variables. That is the meaning of correlation. There are different types of correlation you have to understand. There are 3 types. Number 1, perfect correlation. Number 2, partial correlation. Number 3, no correlation. Now we are going to explain you through diagram what each of this means. In the exam, you don't have to draw a diagram, but diagram might be given to you. Then you should know what type of correlation it is. First, perfect correlation. For perfect correlation, this is how a diagram will look like. That means if you see all your X points, based on the data you have plotted this X point, right? Just if you see they fall on a straight line. That is known as perfect correlation. Perfect relationship is there. For this type of data, you can use a regression analysis because that also assumes straight line. But if you can see that on the first diagram, on the left hand side, the line is going upwards. From left to right is increasing. What does it mean? Higher the X, higher the Y. But in the second one, higher the X, lower the Y. It's an opposite relationship. Even though both are perfect relationship. But the diagram on the left, where X is increasing, Y is increasing, is known as positive correlation. Please understand the word positive. Perfectly correlated, yes, but it's positive also because both are increasing. If one is increasing, the other is decreasing, which is on the right hand side diagram, the second diagram, that is known as negative correlation. So the first is positive, second figure is negative correlation. This you have to understand. Partial correlation. Now see the diagram. Some x's are on the lines, closer to line, a little away from the line, but partially they are correlated, not so correlated, not no so correlated, not very correlated, but somewhere in between, partially. Then no correlation. You see, they do not fall in the straight line. Some are here, some are there. You cannot tell if x increases, y will increase, because for some they are increasing, for some they are not increasing, for some they are, no correlation. It's here, there, everywhere. Now, the correlation coefficient. What is the meaning of correlation coefficient? For that, the letter is R. That means the degree of correlation. Now they will give you a number to that. Earlier it was through a diagram. They will give you a number. That is the meaning of coefficient. Number will be given to that correlation. Based on that number, you can tell how strongly or how negatively correlated they are. And this is measured by a letter called R. You will see R. This R has to be between -1 and -1 only. In this range only it could be always. It cannot be too negative to no. From -1 to +1. Then if R is positive, sorry, if R is 1, positive 1, perfectly positive correlation. Positive correlation because +1. If it's -1, negatively. But it's perfect because it's exactly 1. That means all the data falls on that straight line. If it's 0, R is 0, no linear correlation. If R is -1, again it's perfect, but it is negative, perfectly negative correlation. Okay? But they might give other values also. You might not in the exam exactly get, they will not give you +1, 0, 1 or -1. They might give you things like negative -0.8 or plus 0.8. What does it mean? If it's 0.8, see, this is a general rule that is taken for you to make things easier in the exam, okay? If R is that is given to you is greater than 0.8, take it as a strong correlation, strong positive correlation. If it's less than negative -0.8, again it is strong but negative correlation. Why strong? See, 0.8 means 80%. That means 80%, like above 80%. It's positively correlated. Whether positive or negative, it is based on the number of the sign. If it's positive, 0.8, positive. If it's negative 0.8, -0.8, it's a negative. But it will be perfectly correlated. Strong or weak correlation. Okay. If it is greater than 0.8, both negative and positive, it is strong correlation. If it falls below 0.8, it's a weak correlation. That means relationship is weak. Understanding? But you can gather even more meaningful information having R squared. You read it as R squared. That is known as coefficient of determination. So where they give you both R and R squared, decide based on R squared. R squared is more effective than R. Okay, for R squared also they will give you. That means the more confidence they can have in an equation. That is the meaning of R squared. Higher this R squared, better it is for you. Because higher R squared means you can have more confidence in the equation. That is the meaning of it. For example, let's say R squared is given as 0.8. How do you interpret? That means 80% of the variation that is happening in the factory overhead is from the machine hours. You can explain it through machine hours. Remaining 20% you cannot explain. It is something other than machine hours which you also cannot explain. So that remaining 20% is known as error term. You name it as error term. You don't have to worry about that 20%. But at least 80% of the data changes in the factory overhead could be explained through machine hours. That much confidence you can have if you given R squared as 0.8. That means 80%. Okay, because they already told factory overhead is a function of machine hours. Now there are limitations of this correlation also. What is it? Number one, it is used on sample data and it will be misleading. Okay, you're taking it from sample that can have an error. You're not taking it from the population. So you might have come across a random sampling error. Maybe due to some coincidence, there might be some relationship. Maybe actually there might not be any relationship, right? Second, if a correlation coefficient is zero, what does it mean? It could fail to detect any obvious relationship, even if it's not a linear one. For example, correlation coefficient is also zero in this case. You see the diagram? It's like a V. Third, remember, correlation and causality are not the same thing. What is the difference? Correlation means what is the relationship between two variables. But it does not automatically imply that one causes the other. Maybe there could be a relationship, but it does not mean because this is happening that will happen. So X and Y are correlated in some way. Does not mean that if X causes a change in Y. No. For instance, let's see this. These are the two variables, okay? One is sunglass, one is ice cream sales. We know intuitively that there's no way one variable has a cause and effect. Does it have a cause and effect? You buying sunglass will give you more ice cream sale? No, no cause and effect. But both of them will be greater. The sales will be greater in the month of summer. We know that. So in terms of correlation, you can say both are strongly correlated with each other because both are sold in summer. But they are not having an impact on each other. The sale of sunglass will not cause a sale of ice cream. Understood? Time series analysis, the third. It can be plotted on a time series. These are the examples. One is monthly rainfall in London, daily closing sale price of share on stock exchange, monthly sale in a department store, and this is the diagram of the time series analysis. X-axis, you can see the times are there. Y-axis, that is the volume of sales. And you have been given the two. One is basic trend. You can see the basic trend is in a straight line or a little curved. But actual data, if you see, it is like a zigzag. Sometimes it's below the line, sometimes it's exactly on the line, sometimes it's above the line. That is the actual data. What are the characteristics of a time series component? Basic trend, long term. Cyclical variation. Cyclical variation happens in between that time, right? That is medium term only. Random variation sometimes happens. Suddenly sale increases, suddenly sale goes down. That is for short term. And the fourth is seasonal variation. This is also short term. What are the advantages of time series analysis? It identifies seasonal variations. Second, can be non-linear. Third, accurate. It's very accurate because you will get the data also on that time. Disadvantages is complicated. Season may change and based on historical data again. Less useful on the long term. Remember, time series analysis. For short term, yes. If you have to use the same time data for 2 years, 3 years, it's not useful. Now, there are a number of problems using time series. What is it? Number one, inherent weaknesses of extrapolation. Okay, even though in the past you see it has moved in a particular manner, does not mean in the future also it will move in that manner only. Maybe in the present you don't have that seasonal variation or anything, but next year you might have that variation. Understanding? Second, seasonal adjustment. Even seasonal adjustment also, what do? You base it on historical figure. But that does not mean that just because today you're having seasonal variation, next year also you'll have the same seasonal variation at that time. No. Maybe it is just for this year. Now, let us summarize everything that we have discussed because we are over this lecture. And this is the last lecture also under finance. Next lecture will be for the last section of your SBL, that is strategic change management. So standard costing. Under standard costing, we went through the problems that it ignores improvement. Okay, because modern environment is continuously they want to improve, like just in time or quality control management, right? Just for them, you cannot use standard costing. Less useful in automated environment. Yes. Budgeting, all the 6 types of budgeting: periodic, rolling, zero based, activity flexed, right? For budgeting, all need to participate. They should motivate. Budgeting should motivate. Budgeting should be set in a level, not too high, not too low, but it should motivate. It should communicate the goals, support the strategies. Then forecasting. Forecasting, we use linear regression. They identify trends. We use time series. They analyze based on the time, or you can say seasonality. Then we finish with variance analysis. They must be based on the flexed budget, not original. And it is difficult to assign and cause a responsibility. You cannot exactly tell that because of this only this variance happened. There may be other factor that variance analysis might not be able to get it. But anyway, understanding the reasons or able to analyze is the key in all this in SBL. That's what you need to remember. So thanks for watching, and do questions on budgeting, linear regression, variance analysis. Pick up the questions in revision kit and start doing it from the past paper. As you know, exams is just next week. So each day I'll be uploading one lecture, and by 1st of September we'll be over with all the SBL lecture. And then I'll be doing one past paper, inshallah, before the exam of SBL. One past paper. So see you in the next lecture, and thank you for watching. If you haven't subscribed to my channel, please do subscribe to my channel. Okay, thank you for watching.